We now turn to FFO, perhaps the most widely used metric in real estate. It's a real estate specific metric to try to arrive at cash generated from operations. It starts with net income to common, which is calculated in accordance with US GAAP, so it's an easy way to start. It's a simple way to start the calculation, and every income statement has it. And we add depreciation from continuing discontinued operations as well as depreciation from JVs. That's the major non-cash add back. And that's consistent with, I suspect, many of your past work in forecasting free cash flows, etc. Less gains on sale. Gains on sale are non-cash income that affects the income statement. We want to back out the gains on sale, and for REITs, that's pretty significant, so we subtract that from net income. Plus non-controlling interest expense. Non-controlling interest expense, you may recall, is a non-cash expense that reduces net income to common. We want to add that back because it is non-cash, but then we do want to subtract out, conversely, cash distributions, actual cash payments to non-controlling interest, and that equals funds from operations. Now, the nice thing about funds from operations is that it's actually consistent. It was developed by Nareit, which is the organization tasked with laying out standards and industry information for REITs. And it's an attempt to reconcile accounting GAAP net income to a consistent measure of profit, which is specifically tailored and relevant for REIT analysis. Most REITs adhere to Nareit's definition and provide FFO reconciliations in their filings. The big difference between EBITDA and funds from operation is that whereas EBITDA attempts to capture profitability from operations, FFO is actually a levered metric. It does capture the effect of taxes, preferred dividends, as well as leverage. And though funds from operations is actually somewhat understood in terms of what it does and what it doesn't do, bear in mind that funds from operations is not designed to be a measure of cash flow because it does exclude working capital changes. It does exclude, and this is a big one, capital expenditures, as well as perhaps other cash flow adjustments. And we're going to get into some of those adjustments in just a moment when we talk about adjusted funds from operations. Before we get into adjusted funds from operations, let's look at how our case study, Bree Properties, actually identifies funds from operations in its own financial statements, or I should say in its own disclosures. Because of the importance of funds from operations as an industry metric, REITs usually disclose FFO in their filings despite the fact that it's non-GAAP. So here you see, right from their 10K on page 35, that funds from operations, the full reconciliation is laid out where it starts with net income and makes all the adjustments that we've been talking about. There's also a footnote right below it that identifies why it's used, why Bree Properties thinks that FFO is a useful way to look at profitability as opposed to, say, just net income. In addition, management almost always for REITs provides guidance for what future funds from operations are going to look like. So if you look at Bree's 2012 supplement, you'll see that in addition to guidance for net income to common shareholders, you see a reconciliation that brings you to a funds from operations guidance. So whereas they expect net income to common of 76 to 84 million, they're actually expecting 182 to 191 million in funds from operations. And that primarily, as you can see, has to do with the fact that there's this major depreciation add back. In our model, you may recall, we did forecast some gains on sale. Those are going to be significant as well, and there's going to be a deviation from what we've done and from what management is guiding to, because as you may recall, management is not guiding towards or is not explicitly providing any estimates for what gains on sale may be. Now let's talk about core funds from operation. Many REITs find that the Nareit defined funds from operations is somewhat limited because it does not allow for the exclusion of certain non-recurring items. So for example, management from Bree wants us to exclude certain things that funds from operations, that FFO, or at least the official definition of FFO, doesn't allow you to exclude. Things like non-operating asset impairments and valuation allowance expenses. These are things that arguably should not and are not recurring, but given the limited definition of FFO, or the narrow definition of FFO, management can't exclude it for that purpose. Property acquisition costs and write-offs of property acquisitions. Gains and losses from early debt extinguishment, prepayment penalties and preferred share redemptions, executive level severance costs, gains and losses on the sale of non-operating assets. All of these arguably are non-recurring or unusual items that should not be integrated into the core funds from operation calculation. At least that's the argument that many management teams make. And as a result, you see that there are often second disclosures, adjusted funds from operations disclosures, that take the initial point as Nareit's definition of FFO, but then make all these adjustments, and these are the main ones that we've laid out here. Now, because that's become fairly widespread, there's been an effort to create some consistency around the adjusted FFO calculation, although that's not as successful as the widespread adoption of the standard FFO calculation. The most common adjusted definition is often called cash available for distribution, or CAD. It's also called adjusted FFO. And it basically starts with FFO and adds the non-recurring items that we talked about before, and it also subtracts capital expenditures. So as in the prior slide, notice we had talked about how BRE wants you to take out a whole bunch of non-recurring items, but BRE is not actually excluding capital expenditures. And there has been an effort to exclude capital expenditures when looking at adjusted funds from operation or cash available for distribution. The logic being that is a core required reinvestment into the business, and that should be taken out when looking at the value of the business or looking at metrics that are then used in comps analysis to figure out what the value of the business should be, which is a compelling argument. The big difference between CAD and the official Nareit FFO definition is that CAD removes non-recurring items and removes capital expenditures. And while Nareit recognizes that many analysts add to the official definition of FFO in this way, it's not an officially recognized metric by Nareit. And here we see that BRE has their own definition. We talked about how companies, it's still a little bit of the wild, wild west in terms of adjusted funds from operation definitions, and that makes comparability challenging. And we see that, like many REITs, BRE does provide a core or adjusted FFF disclosure. But notice that whereas it starts with the Nareit defined funds from operations, it does not take out capital expenditures. It does make all these adjustments. It does exclude any asset impairment charges. Had there been any redemptions related to preferred stock or acquisition costs or severance charges, or some of these other line items, they would have taken them out, but they're not taking out CapEx. Other companies do take out CapEx. In addition, BRE also provides not just FFO guidance, but also core FFO per common share guidance. And we see that for BRE's purposes, since there's not much difference going forward, between core FFO and just regular FFO, the guidance is identical to both core FFO and FFO.